Welcome back to the Deep Dive. We are the place that takes your raw source material, the articles, the investor presentations, the research notes, and turns them into actionable, contextualized insights.
And today, we are taking a detour, a big one.
We really are. We're going into a corporate world that I think most people, they just dismiss it instantly. We're talking about industrial sorbent minerals.
It sounds like the most boring place on earth, right? Clay, dirt. But the company we are focusing on, Oil-Dri Corporation of America, or ODC, is this fascinating paradox.
How so?
Well, superficially, if you just glance at the business description, they look like a relic. You know, a small cap, cyclical mining operation that basically sells clay for kitty litter and floor absorbents.
And for most of its history, that's exactly how the market treated it,
Yeah.
as this sleepy, uninteresting commodity business.
But our sources, they suggest that ODC is undergoing a profound structural transformation. This isn't just a good year, a cyclical uplift.
No, this is different. It's being driven by a deep internal strategic pivot, a strategy they've actually dubbed Moneyball.
That's the hook. That's the whole story right there. They are changing their entire mindset. They are actively favoring margin maximization and these high-value applications over the raw pursuit of just growing volume.
Selling more stuff.
Right. They're trying to sell better stuff. And this shift, it fundamentally alters the entire economic structure of the company.
So our mission today, as dictated by your sources, is to really analyze this transformation. Does ODC now possess a durable economic moat? Is this recent financial success, is it a permanent structural shift, or are we just watching the peak of a short-lived cycle that's just going to revert back to the mean?
And you have to start with the financial proof because it's honestly staggering. We're talking about an industrial company, a materials processor, that saw its return on invested capital, its ROIC, expand dramatically.
Okay, so what are the numbers?
In fiscal year 2025, ODC achieved an ROIC of approximately 19.8%.
Wow, nearly 20% ROIC. For a business that, at its core, digs dirt out of the ground. I mean, that requires huge capital investment. Land, kilns, heavy machinery. That is a massive return on those assets.
It is absolutely massive, especially when you contextualize it against their internal cost of capital. Their weighted average cost of capital, or WACC, it sits at roughly 11.56%.
Okay, so they're borrowing and financing at about 11.5%.
And they're generating returns of nearly 20% on that capital.
That's the magic formula.
That's it. When your ROIC consistently and robustly exceeds your WACC, you are creating true economic value. In ODC's case, that spread is an enormous positive 8.2%.
8.2% positive spread.
That delta, that gap, that is the financial signature of a business that has fundamentally changed its profitability. So we need to dissect exactly how they engineered that structural break from their commodity past.
So let's unpack the machinery of ODC, because the sources are really clear on this point. We cannot think of them just as a mining company or a manufacturer.
No, you can't. They are a material science company that controls the entire value chain, starting literally from the geology.
Control is the key word there.
Control is the key operative word. Their business model is entirely based on vertical integration. It begins with mining. So they own or lease the extraction rights to specific proprietary mineral reserves. We're talking calcium bentonite, attapulgite, and diatomaceous shale.
So they're not just buying generic clay on the open market from anyone.
Not at all. They are using unique, often exclusive geological deposits. This is their foundation.
And once they pull it out of the ground, the whole process stays in-house.
That's right. The next step is processing. This involves very high-energy thermal processing, grinding, specialized sizing, and it's all done at company-owned facilities.
So this is not simply drying the dirt.
Oh, no. This is where the material science really begins. They're preparing the clay for specific high-value applications. And then finally, you have innovation, where their R&D is focused entirely on mineralogy.
So they're figuring out how to get the most out of these unique clays they own.
Exactly, whether it's for advanced filtration or, specialized toxin binding in animals, it's a full stack operation.
That complete end-to-end control from the mine face straight to the packaged product, that must give them a really unique position in the market.
It does. They have total control over both their input costs, which is huge, and the final output specifications of the product.
Okay, so to really appreciate this Moneyball strategy, we have to understand the two sides of their business. They have two reporting segments, right?
Right, and they each serve a drastically different purpose. It's almost like two different companies under one roof.
So let's start with the biggest and the oldest part of the business, the retail and wholesale group. The R&W group. This is the volume anchor for the whole company, right?
That's the perfect term for it. This group, it accounted for roughly 62% of consolidated net sales in FY 2025. It's the bulk of the business.
And this is where most of us would interact with ODC, even if we don't know it.
Exactly. This is dominated by the cat litter business. So they sell their own branded products. You might have seen names like Cat's Pride or Johnny Cat. But critically, they are also one of the dominant suppliers of private label. So store brand cat litter.
To pretty much every major retailer.
To nearly every major retailer in North America. That dual track strategy is so important.
Why is that? What's the strategic thinking there?
Well, it ensures that their expensive kilns, their processing facilities, that they are running 24/7. Volume keeps the lights on, and it helps absorb a massive fixed costs. You have to keep the factory running.
But that's also where the problem is, or where it was.
Precisely. This is the segment where the financial struggle originates. Because while running at full capacity is essential, the heavy reliance on private label introduces just intense margin pressure.
Because you're supplying giants who hold all the bargaining power.
You've got it. The second part of the R&W segment is what they call industrial and sports. These are legacy products. We're talking clay granules for floor absorbents, to soak up oil spills in garages.
Or on baseball fields.
Or specialized products to manage moisture on baseball infields, exactly. They are low growth, low drama, but very reliable cash flow generators that don't require much new capital investment. They're cash cows.
Okay, so that's the volume side. Now we pivot to the part that's driving the structural change and those phenomenal ROIC numbers. The business-to-business or B2B group.
Yes. This is the designated margin engine. This is where the magic is happening.
And it's a smaller piece of the pie for now.
It is. The B2B group accounted for about 38% of sales in FY 2025, but this is where that materials science approach truly pays off. This is where the company is redirecting its capacity to maximize the profit per ton of clay they process.
That's the heart of Moneyball.
That is the heart of Moneyball.
So what are these high-value industrial solutions they're selling here?
Well, the first and currently the most dynamic area is fluids purification. This is where they produce highly specialized bleaching clays, marketed under brand names like PureFlow and Perform.
Okay, bleaching clays, what are they used for?
Historically, these clays were vital for removing impurities and, color bodies from edible oils. Think your soybean oil, palm oil, canola oil.
So we're cleaning up cooking oils.
Yeah.
A stable, but let's be honest, pretty unexciting industrial application.
Right. But here is the critical nexus point. This is the big shift. These same specialized clays are now essential for filtering renewable diesel feedstocks.
Ah, okay. Now that is interesting.
It's a game changer. That includes used cooking oil, corn oil, and highly contaminated animal fats like tallow. These feedstocks are far, far dirtier than typical crude oil.
So they need a lot more cleaning.
A lot more. They require this complex pretreatment to prevent downstream damage to these multi-billion-dollar hydrotreating catalysts in the refineries. So ODC's B2B division is now a direct, essential component of the global energy transition.
That immediately upgrades the perceived value of their product. It goes from being a commodity filler to a strategic, almost high-tech component in the energy supply chain.
It really does. The second area is agricultural carriers. ODC uses their specific mineralogy to create these granular carriers like their Verge brand.
So what's a carrier?
Well, instead of spraying expensive crop protection chemicals, pesticides, fungicides in a liquid form which can drift in the wind.
Right, and go where you don't want it.
Exactly. These granules deliver the active ingredient directly and efficiently into the soil, right where it's needed. It's safer, more targeted, and it reduces waste.
Okay, and there's a third B2B segment, the one with the highest potential margin.
Yes, the highest potential, but also the highest risk. Animal health, led by their Amlan International Division. This is pure bioscience meets mineralogy. It's fascinating.
So what are they doing?
Amlan develops these specialized mineral-based feed additives. They're designed to bind and neutralize bacterial toxins, things called mycotoxins, in the digestive tracts of livestock and poultry.
Which directly addresses the huge consumer and regulatory demand for no antibiotics ever products in our food supply.
It's a high-growth, high-margin solution for a global problem. They're offering an alternative path to gut health that doesn't rely on traditional pharmaceutical interventions.
But it must be a tougher sell.
Oh, it is. It requires intensive R&D, very long sales cycles, specialized regulatory approval. But the proprietary nature means the potential profit per ton is exponentially higher than the margin they get selling generic clay floor absorbents. Now that we understand the business structure, we have to rigorously assess the competitive landscape, because generating a sustained 20% ROIC, that requires a very strong defensive position.
A moat.
A moat. And our analysis confirms ODC has a narrow economic moat. It's not a wide moat, but it is deeply entrenched and highly effective.
And this moat, it isn't based on an intangible like brand recognition or network effects. It's driven by two very tangible things.
Right. Geology and technical process know-how.
The foundation of the moat is literally geological.
It is. It's an intangible asset in the sense that you can't just go out and replicate it easily. ODC owns or controls rights to over 149 million tons of proven reserves.
Which is a lot.
It is, and that volume is necessary for supply security. But the real power lies in the unique quality of one specific deposit, the Blue Mountain, Mississippi facility.
Okay, so what makes the clay from Blue Mountain so special compared to what their competitors are mining?
It's the specific mineral composition. It's a type of calcium bentonite. And due to its unique geological formation, it's naturally low density and incredibly absorbent.
So it's lighter.
It's lighter. And most commercial cat litter is made from sodium bentonite, which is much, much heavier. So this single geological advantage translates into a profound structural lightweight cost advantage that competitors just cannot easily overcome.
And this cost advantage is most acute in the R&W segment, right? For the low value to weight products like cat litter.
Precisely. You have to think about the unit economics of cat litter. It's bulky, it's heavy, and it's cheap.
Yeah.
So freight, the cost of transportation via truck or rail, can often account for 30% or even more of the final consumer cost.
That's a huge chunk of the cost.
It's massive. And because ODC's calcium bentonite is naturally 25 to 50% lighter than the standard sodium bentonite, ODC is shipping the exact same unit of absorption functionality.
But with drastically reduced freight costs per bag.
So ODC is paying significantly less in fuel and logistics to move the exact same product utility. That gives them a permanent structural cost advantage over any competitor trying to supply the market from a distant sodium bentonite-based mine.
Can't competitors just make their litter lighter?
Well, they do try. Competitors try to create lightweight litter, but they usually have to inject expensive synthetic additives or polymers, or use specialized and very energy-intensive chemical treatments to kind of fluff up the clay.
Which immediately raises their production costs.
Right. ODC's advantage is inherent in the raw material itself, which is the strongest form of competitive advantage you can have in a commodity business.
Okay, that confirms the geologic moat. Now let's talk about the second half of it, the vertical integration and technical lock-in. You said competing with ODC requires massive capital and time.
Yeah, vertical integration acts as this multi-layered barrier to entry. First, securing mineral rights is difficult. Then, securing multi-year mine permits in North America is an arduous, bureaucratic process.
And that's before you even build anything.
That's before you've spent $1 on a factory. Finally, you have to construct the specialized high-temperature kilns and the processing infrastructure. We are talking about massive capital hurdles and a multi-year lead time. No startup can just walk in and immediately compete with ODC's existing capacity network.
But the real technical lock-in, that happens in the B2B segment, specifically in fluids purification. This is where ODC turns geology into high-tech material science through their processing, right?
Yes, through a process called calcining. It's the thermal processing of the clay. And it's not just baking clay, it's an art form.
An art form.
While ODC's R&D focuses on controlling the intense thermal gradient inside the kiln to manipulate the pore structure of the clay particles at the nanoscale.
Okay, so why is controlling the pore structure so critical for, say, a renewable diesel producer?
Because every refinery's feedstock is different. Tallow, or used cooking oil, it often contains highly variable amounts of metals like nickel, vanadium, or even residual polyethylene from plastics.
All of which act as poisons for their expensive equipment.
Poisons for the expensive downstream hydrotreating catalysts. So ODC custom calibrates the calcining process to create a clay with the exact pore size distribution and surface chemistry necessary to selectively absorb that customer's specific contaminants, maximizing their removal efficiency.
So ODC is essentially custom tailoring the filtration clay for each specific refinery's input supply.
Exactly. And once a refinery calibrates its massive filtration system to ODC's clay, a specific formulation that they know works perfectly, switching becomes extremely risky.
Because the cost of failure is so high.
The cost of a few dollars saved per ton on clay pales in comparison to the operational risk of using an untested clay that might fail to catch contaminants. That could lead to catalyst fouling and a multi-million-dollar, multi-week production shutdown.
That operational risk creates technical switching costs that are practically insurmountable. That secures ODC as this sticky, high-margin supplier in the fluids purification segment.
This is the essence of the narrow moat. Now, we have to verify this advantage with the financial data again. We mentioned the staggering ROIC expansion, but let's narrate the historical struggle to really appreciate the shift.
Let's put that 2025 ROIC of 19.8% into context. What did it look like before?
Well, before the structural change, so from 2021 back through many previous years, ODC was actually a value destroyer.
The value destroyer.
Yes. In FY 2022, for instance, their ROIC was a meager 6.3% against a WACC of 8.2%. That was a consistent negative spread.
So they were earning less on their capital than it cost to finance that capital.
Which is the definition of a commoditized mining operation that destroys shareholder value over time.
So the market was right to price them as a legacy dinosaur back then. They weren't earning their cost of capital.
They weren't. The inflection point was aggressive and immediate, and it coincided exactly with the Moneyball implementation. The spread turned positive sharply in 2024, a positive 5.7% spread, and then it just exploded to the plus 8.2% spread in 2025.
So it's not a gradual improvement.
Not at all. It's a sudden structural jump in profitability, and it proves that the technical and geological advantages are finally being monetized through higher pricing and a superior product mix.
We've established the strength of the moat, but let's follow the source analysis and acknowledge why it's only narrow, not wide. Where are the vulnerabilities?
They are almost entirely confined to that big retail and wholesale segment. The first vulnerability is just retail commoditization.
They're up against giants.
They are. While ODC has premium products, brand loyalty for something like Cat's Pride is tenuous against the immense marketing budgets and the shelf space leverage of conglomerates like Clorox, who makes Fresh Step, or Church & Dwight with Arm & Hammer.
Which prevents ODC from consistently getting premium pricing across their whole retail portfolio.
Exactly. And the second and more painful limit is the private label dilemma. This introduces what economists call a monopsony dynamic.
A monopsony.
This is the structural tension in the business. ODC uses private label sales to keep the kilns running at capacity, but that relationship exposes them to a monopsony, where a single large buyer, like a Walmart, dominates the market and has unilateral power to dictate terms.
It's the flip side of a monopoly. One buyer, many sellers.
Exactly. Think of ODC as a factory that provides, 19% of its entire output to one enormous customer. If Walmart decides to demand a 5% price reduction on the store brand litter, ODC has to largely accept it.
Or risk losing a massive chunk of their volume and suddenly facing huge fixed cost underutilization.
That constant threat limits their pricing power on over half the business, and that's why the moat is narrow, not wide.
Okay, so this inherent limitation in the R&W segment is exactly why that internal strategy shift was so necessary. Let's dig deep into the Moneyball strategy. This pivot from simply chasing volume to aggressively prioritizing value.
Well, the strategy was really driven by external pressure. It was the massive inflation spike in 2022 and 2023. Costs for their key inputs, natural gas, which is essential for the thermal processing, for the kilns, and diesel fuel for freight, they just went parabolic. So ODC had a choice. Absorb the cost and watch your margins just vanish, or pass the costs on and see who drops off.
And they chose the latter. They aggressively raised prices.
They did. And this wasn't a passive move. They consciously decided to, in effect, fire their lowest margin customers.
That's the revolutionary part of Moneyball.
It is. They deliberately accepted the loss of price-sensitive, low-quality volume, the generic, coarse clay floor absorbents, or the cheapest bulk cat litter contracts. They knew those contracts were barely breaking even.
So losing them actually made the business healthier.
Much healthier. And this action led to the creation of what the sources call synthetic capacity. We should explain that concept because it's a brilliant capital-light maneuver.
Okay, what is synthetic capacity?
It's the highest leverage move they could possibly make. Instead of spending potentially $100 million or more on new capex to build a brand new facility to service their growing B2B purification customers,
They just optimized what they already had.
They simply optimized the utilization of their existing assets. By firing their low-margin volume, they instantly freed up capacity kiln time, drying time, processing time that could be immediately reallocated to the high-value B2B products.
Like the renewable diesel clays.
Exactly. So they created capacity without spending a dime on construction, and in the process, they structurally lifted the entire gross margin floor of the company.
Brilliant.
The capacity that was earning them near zero economic profit is now dedicated to products earning the company that positive 8.2% ROIC spread. The efficiency game is massive, and it is the core driver of this structural change.
And we see the irrefutable evidence of this operating strategy in the FY 2025 growth data.
Yeah, look at the disparity. The net sales CAGR over the 5 years leading up to 2025 was robust. It was approximately 12.3%. That's good top-line growth.
But the bottom line grew much faster.
Much faster. The operating income TAGR during that same period was a stunning 31.2%.
That differential is the signature of successful operating leverage. You only see operating income growth outpace sales growth that dramatically when you are fundamentally changing the profitability of the average sale.
Right. They are selling better, not just more.
They shed the non-performing volume.
Exactly. Now, FY 2025, that was the year this strategy truly paid off. The sources summarize it as the perfect storm.
Okay, so let's detail the convergence of positive factors that led to these record gross margins of 29.5% and a huge $80 million in operating cash flow.
It was a perfect alignment of macroeconomic factors and their own execution. First, they achieved the full realization of the multi-year price increases they implemented back in 22 and 23.
So those price hikes finally flowed all the way through the system.
They finally hit the P&L. Second, the external environment stabilized. Natural gas and global freight costs came down from their crazy peaks. Third, the renewable diesel boom accelerated massively, and that demanded huge initial volumes of their specialized clay.
And fourth, the strategic acquisition they made also started to contribute right away.
Yes, the Ultra-Pet acquisition. It added $10.4 million in incremental sales, boosting their retail presence in the fastest-growing niche. So you put those four forces together: higher pricing, lower input costs, massive new B2B demand, and synergy from an acquisition, you get record-setting gross margins.
Okay, let's shift focus to these external industry tailwinds, starting with the R&W segment. Let's talk about the cat litter market dynamics.
Okay, so this is a mature, low-growth oligopoly. The overall market grows slowly, maybe 4 or 5% CAGR. It's dominated by four major players, including ODC, which leads to generally rational pricing behavior.
Nobody is starting a crazy price war.
Exactly. The major trend here, however, is premiumization.
Consumers are actively trading up from basic clay.
They are. The market share for standard, non-clumping clay is slowly eroding in favor of premium clumping litters and, more importantly, alternative substrates.
Like silica gels, crystals.
Silica, crystals, corn, or wheat-based products. These can command prices of $20 or more per bag. This is a slow, secular threat to ODC's massive bentonite reserves.
And that secular threat explains why the Ultra-Pet hedge was so necessary.
It was a matter of strategic survival. That $46 million acquisition in May 2024 immediately gave ODC access to the silica gel and crystal segment, which is the fastest growing niche in the whole category.
They didn't just buy a company, they bought an insurance policy.
And a fast track into premium markets. And because ODC already had these massive relationships with major retailers for Cat's Pride and their private label business, the synergy was instant.
They could plug the new products right into their existing network.
Right. The sources noted a swift 58% increase in brick-and-mortar crystal distribution very early on. It proves they could leverage their existing distribution pipes for the new product. It was a smart move.
Now for the most powerful driver, the secular tailwind of the renewable diesel, or RD. Boom! This is what turns a good B2B segment into an explosive one.
This is not just market growth. This is regulatory-driven structural demand. Policies like the California Low Carbon Fuel Standard and the Federal Renewable Fuel Standard have essentially mandated the expansion of RD capacity.
So the government is forcing this to happen.
Pretty much. The capacity jump in the U.S. has been historic. It went from 800 million gallons in 2020 to an estimated 6 billion gallons by 2025.
Wow. That is sevenfold growth in 5 years.
It's incredible. And every single one of those new refineries, they need ODC's clay.
The demand grows linearly.
Linearly. Demand for their specialized bleaching clays grows directly with this capacity. And ODC is one of the few technically qualified North American suppliers offering the logistics advantages and the supply security that these massive refinery operations demand. The high volume of initial refinery fills in 24 and 25 is the direct result of this regulatory boom.
Okay, finally, let's revisit Animal Health Amlin International, the segment with the highest potential margin, but also the highest execution complexity.
The opportunity remains immense, and it's driven by that global regulatory and consumer push for no antibiotics ever. Amlin's mineral solutions, they are effective because they are naturally binding toxins that reduce inflammation and improve feed conversion rates in animals.
So the animals get more nutrition from the same amount of feed.
Right. And it's a proprietary, non-commodity solution. It positions them as a premium, science-backed supplier. The potential for margin expansion here is greater than any other segment, but translating that potential into consistent revenue, that's the challenge.
So we've built this really powerful narrative of transformation, but investment theses are rarely a smooth, straight lineup. We have to introduce the significant tension created by the Q1 2026 reality check. This is for the quarter ending October 31st, 2025.
Yeah, this quarter was the market's immediate skepticism realized. Net sales declined 6% year over year to $120.5 million.
And the growth engine took a hit.
It did. More worryingly, the engine of growth, the B2B segment volume, it contracted by 9%. And consequently, operating income plunged by a dramatic 20%.
Ouch.
It immediately begs the question, did the Moneyball structural change just reverse itself? Is the magic gone?
Management attributed this contraction to what they call the fill cycle nuance in the renewable diesel segment. We need to explain what that means and why it creates this kind of lumpiness.
Right. The nature of B2B industrial supply is often lumpy. It's not smooth. When a massive new refinery opens, they don't just buy a little clay. They require an initial fill, which is a massive one-time procurement of material just to charge the whole system.
And that provides a huge non-recurring boost to sales volume.
Exactly. And fiscal year 2025 saw a massive concentration of these big initial fills.
So Q1 2026 was suffering from impossible comparisons. It was up against this huge one-time event in the prior year.
That's it. The Q1 2026 volume reflected the shift away from those one-time mega orders and towards the normal top-up cycles.
Recurring business.
The smaller, recurring replacement volumes required as the clay in the filtration system is exhausted and needs to be replenished. While the recurring top-up volume is ultimately more sustainable, it's much lower than that initial charge, and that leads to the volume contraction we saw.
So it's an issue of timing, not demand destruction. But it definitely introduces volatility.
A lot of volatility, and it wasn't confined to renewable diesel. The Q1 results also exposed a significant execution risk in their most profitable yet most challenging segment, animal health.
What happened there?
That's where the real pain was felt. A 25% drop in animal health revenue.
25%, that's a huge drop.
It is. The weakness was attributed primarily to Latin America, and this highlights the inherent complexity of this division. You are not dealing with steady North American industrial buyers here.
No, you're dealing with international markets.
Volatile currencies, political instability, and much longer sales cycles as farmer and feed producers take a long time to adopt new feed additives.
So this really shows that Amlin's potential is real, but its trajectory is going to be anything but a straight line.
Absolutely not. It requires patience and a tolerance for deep quarter-to-quarter variability. However, despite this short-term blip, management is signaling their long-term confidence through their ongoing operational investments.
So their commitment to CapEx, to capital expenditures, remains high.
Yes. CapEx was elevated at about $33 million in FY 2025. That significantly exceeds their annual depreciation charge of around $22 million.
So these aren't just maintenance investments to keep the lights on.
No, these are growth investments. They're heavily focused on automation to reduce labor costs and improve efficiency, and crucially, on expanding their bleaching clay capacity. They are spending money now because they are convinced the long-term secular demand from renewable diesel and animal health is structurally permanent.
Let's pivot to the balance sheet strength that ODC has built up. Because this is the financial fortress that allows them to weather the volatility we just discussed.
The fortress analogy is very apt. ODC used the massive cash flow from that 2025 perfect storm year to pay down nearly all of their short-term debt.
So where do they stand now?
They now operate with a rare and very valuable net cash position. We're talking $42.4 million in cash versus only $39.8 million in debt as of October 2025.
So they have more cash than debt. A net cash balance sheet that eliminates interest rate risk. It provides a massive cushion against any recession, and it gives them the dry powder they need for opportunistic acquisitions or capital projects.
And it reduces their reliance on external debt markets. This financial discipline is also reflected in their dividend policy.
Right, they have a great track record here.
One of the most reliable dividend histories in the industrial space. They have increased dividends for 22 consecutive years.
22 years.
And the 16% increase they announced in June 2025, that is a massive vote of confidence from the board in the new higher earnings baseline of the company.
And the payout is safe.
Extremely safe. The payout ratio is very conservative, hovering around 22%, which indicates high safety and sustainability.
We should also note the high earnings quality, which results from their capital intensity.
This is a critical nuance for any deep dive. In FY 2025, their net cash provided by operating activities was $80 million. That was significantly higher than their reported net income of $54 million.
A $26 million difference. Where does that come from?
It's primarily due to large non-cash depreciation charges, about $22 million related to their heavy asset base, their mines, their kilns. Depreciation shields income from taxes, but it doesn't cost them any actual cash.
So the company's cash flow generation is significantly stronger than its reported accounting earnings might suggest.
Right, which means the PE ratio, while it looks low, actually understates the true cash flow power of the business.
Okay, but there was one key working capital metric that's serving as a bit of a yellow flag.
Yes, the recent inventory buildup. Inventories rose from $51.6 million to $56.6 million in October 2025, and that happened precisely when sales were contracting.
That is a classic warning sign of potential overproduction.
It suggests the company produced too much inventory in anticipation of continued high volumes that just didn't materialize, likely due to that top-up cycle slowdown. If that inventory doesn't move quickly, it could signal future production slowdowns or even potential write-downs, which would impact profitability in the next few quarters. It's something to watch.
Let's transition now to the key structural risks and red flags. These are the things that the market uses to justify the current low valuation, regardless of that strong ROIC.
And the number one risk, the largest existential threat to ODC's stability, is customer concentration. We can call it the Walmart risk.
We mentioned it earlier. Walmart accounted for approximately 19% of net sales in FY 2025.
19%. So almost 1 out of every $5 that ODC makes comes from the continued good graces of a single notoriously powerful buyer.
That is a massive amount of leverage for one customer to have.
It creates that classic monopsony threat we talked about. If Walmart decides to push aggressively on private label pricing, or worse, if they decide to allocate more shelf space to a national brand like Arm & Hammer at the expense of Cat's Pride or ODC's store brands.
The impact on ODC's profitability would be immediate and severe.
They are functionally a price taker for a significant portion of their volume. This concentration risk demands a permanent discount in the stock's valuation. There's no getting around it.
Okay, the second major factor justifying the discount is corporate governance. This is pretty typical of a family-controlled small-cap company.
Right. ODC operates with a dual-class share structure. The public common stock that you or I could buy gets 1 vote per share.
Standard.
But the controlling Jaffe family owns virtually all of the Class B stock, which carries 10 votes per share.
10 votes, okay.
This arrangement legally grants the Jaffe family absolute voting control, regardless of the size of the public float.
So public shareholders are essentially passive passengers. They are unable to influence major strategic decisions, like demanding a sale of the company or forcing a change in management.
That is exactly the legal implication. And while the Jaffe family has historically been competent and conservative stewards of the business, this structure means minority shareholders have no real recourse. This complete lack of voice creates a systemic governance discount in the stock's valuation.
Which leads us directly to the third key critique, their capital allocation. Given the high ROIC and the ridiculously low PE valuation, why doesn't the family, which controls the company, execute aggressive, value-accretive share buybacks?
It's a choice, and it's driven by that governance structure and their inherent risk aversion. Management prioritizes maintaining a massive liquidity buffer, hence the net cash position, and consistent dividend increases over aggressive buybacks.
Even when a share repurchase at 13 times earnings would immediately boost EPS.
Even then, They are conservative stewards focused on preserving multi-generational wealth and liquidity. And they also want to avoid the risk of shrinking the small public float too much, which could impact trading liquidity for the stock.
It's interesting conflict then. The action that would financially maximize returns for public shareholders, which is buybacks, is subordinate to the family's priority of stability and liquidity.
It is a critical tension point in the investment case. And finally, we can't ignore the long-term secular threat to their core product.
Right. Clay is still dominant, holding about 80% market share in cat litter.
But that share is slowly shrinking. The trend toward alternative substrates, silica, corn, and others, is persistent and it's real. If the growth rate in the silica segment accelerates dramatically, ODC's massive geographically unique clay reserves, which are the core of their moat, could slowly face technological obsolescence.
Which is the strategic justification for the UltraPet acquisition.
Exactly. It's an internal diversification to hedge against the potential decline of their core mineral asset.
So we've established a high-quality business. It has a fortress balance sheet, a powerful structural competitive advantage in its B2B segment, and management that has successfully engineered this high-margin transformation. Yet the current valuation disconnect is stark. ODC trades at a low PE of around 13x and an EV/EBITDA of 8.2x.
That valuation is puzzling when you put it against the background of a 19.8% ROIC. And when you compare them to the major players in the pet space, the discount is just massive.
How does their valuation stack up against the big CPG giants?
Well, ODC trades at roughly a 50% discount to consumer packaged goods companies that own comparable brands. Clorox and Church & Dwight, they typically trade in the 25x to 28x PE range.
Okay, but you could argue ODC doesn't deserve that multiple.
And you'd be right. Of course, ODC's industrial complexity and their lower gross margins, 29.5% versus the CPG average of 45% plus, that justifies some discount. But the sources show ODC is trading below even Tier 2 industrial peers. They're being treated like a deep value orphan.
So what is the market pricing in at a 13x multiple? What's the story the market is telling itself?
The market is pricing ODC as a classic, no-growth, cyclical commodity miner. The valuation is essentially the realization of the bear case.
Like yes.
That the Moneyball structural change is temporary, that the margins will revert back to the historical value-destroying 6-7% average, and that the renewable diesel boom is merely a one-time surge that won't be repeated.
They see the Q1 2026 contraction, and they conclude the old cyclical forces are already coming back.
Exactly. But if we assume the transformation is structural, and the sustained high ROIC suggests that it is, then this discount is wildly excessive.
It is. Given their superior ROIC, their net cash position, and their leading position in the essential renewable diesel supply chain, intrinsic valuation models referenced in the sources suggest a fair value significantly higher.
Some independent estimates imply a value of up to $150 per share, based on a sustained profitability near that 20% ROIC level.
So at the current price, that suggests a massive margin of safety. You're paying the price of the cyclical, low-margin past, and you're getting the high ROIC material science future for free.
The Q1 2026 volatility, in that context, becomes a tactical entry point. The investor needs only patience, not deep conviction that the margins will expand further, but simply that they will sustain near this current level.
Okay, let's synthesize this whole picture for our listener.
Let's do it.
Oil-Dri Corporation of America is the definition of a hidden champion. They dominate a niche mineral market. They possess unique geological assets that translate into structural cost advantages, and they have successfully reinvented themselves via this internal money hall strategy, pivoting from volume dependence to value maximization.
And the financial proof, a near 20% ROIC that far exceeds their cost of capital, is compelling evidence that this transformation is genuine.
Yet the market remains fixated on the short-term volatility, evidenced by the lumpy Q1 2026 B2B results, and it persists in pricing them like a legacy commodity industrial dinosaur, and that creates this massive valuation gap.
Our final conclusion is that this is a structurally attractive long-term investment opportunity, but it's for those who can tolerate the lumpiness inherent in the B2B segment's fill cycles. Critically, the bankruptcy risk here is negligible thanks to that fortress net cash balance sheet and the inherent value of their proprietary mineral assets. The risk here is time, not permanent capital loss.
It is a phenomenal reminder that the most exciting investment stories often lurk where nobody is looking. In this case, buried in the ground in Mississippi.
Indeed. It's the intersection of deep-value industrial assets and high-tech strategic execution.
So what is the one provocative thought for our listener to mull over as they consider the implications of this deep dive?
Let's connect the conservative capital allocation strategy back to that governance structure. Given ODC's strong balance sheet, its high ROIC, and its extremely low PE multiple, the company is an ideal candidate for aggressive share repurchases.
Right. It seems like a no-brainer.
It does. So the question is this. Is the Jaffe family's decision to prioritize consistent dividends and maintain liquidity while avoiding those aggressive buybacks, is that decision truly maximizing long-term shareholder value and fully capitalizing on the success of their Moneyball strategy? Or is that conservatism merely serving the Jaffe family's own priority of preserving multi-generational control and liquidity, thereby justifying the permanent governance discount that the stock receives? The choice about how to spend the excess cash is the ultimate tension between family control and maximizing minority shareholder returns.
That puts the control issue front and center, right where it belongs. Thank you for guiding us through this surprisingly complex and deeply detailed story.
Always a pleasure.
And thank you for joining us on the deep dive. We'll see you next time.